Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, December 20th, 2019. Just want to start out by wishing everybody happy holidays. Next week we kind of go into the doldrums with Christmas. Obviously the markets close Christmas Day. We have the abbreviated trading day on Christmas Eve. And we tend to go into a holding pattern, so I'm going to talk about a few things, a couple things a little bit different in this video. There really wasn't a lot of new technical developments today on the broad markets, but I want to cover that, cover a couple recent trades, and start here. This is the VIX. As I pointed out in the past, we're at the support zone here. Now this support zone back here, this low end of the range, that was never before seen volatility, never before seen up until that point in the history of the VIX, and never seen since. So we return back to the old normal low end of the VIX, and as I pointed out in several videos in recent weeks and months, this is where all corrections, including that big drop last quarter, have started from. So all the major corrections so far right here, if you put the stock market overlaid it, and I've done that before, I'm not going to get into that now, you can look at the dates here, and that's where the biggest corrections in the stock market have all occurred from. So we're back there. Now, as I pointed out here, sometimes you hit that level and sometimes you trade on it for a while before a correction sets in. In this case, it was months. You had persistent low volatility, and it ended with a bang. As we all know, biggest drop throughout the entire bear market history in over a decade. That was the last quarter into the Christmas Eve lows. So I just want to point that that's where we're at now. And one other chart I want to show you here. Let me pull that one up for you. Is the chart of the Skew index. Remember Tuga, if I pronounced that right, TUGA 2019 posted this chart on the site today and updated that the Skew index. Tuga had pointed out that it's only hit this level 3 times in the past decade. I didn't go back that far to verify that, but well, yeah, actually, this chart, I don't know if that chart goes back a decade, but what I can tell you is right here, you can see there's 2018, 2019. Here's your year break line right here. Remember that the correction started early in October. Again, the biggest drop that the market's seen, and so we have the Skew now at levels that it was back then. This represented the drop back then, or preceded the drop, the big drop into. And remember, we also had a big drop in early around there. Was that in 2017? No, yeah, I'm looking at this chart. No, that's 2017. The other drop was there in 2018, early 2018. But again, so you can see Skew has not hit this level. Last time it hit that level was followed by the big drop. The difference, Skew is similar to the VIX. The VIX tracks at the money options, whereas Skew tracks out of the money option. So when the Skew is spiking, it shows you that investors, whether it's institutions, smart money, retail traders, or a combination of both, are pretty much hedging against big market risks. They're worried about a big drop, black swan event, big drop in the market, and so they're buying out of the money, put protection, things like that on their positions. So just wanted to mention that that's where the Skew index is. So that coupled with the VIX are something to take note of. And then finally, as I said, it's seasonality here. Seasonality is typically bullish in the month of December. So far, that's been the case. You talk about the Santa Claus rally they've talked about for years. In January, you often have the small cap effect, where small cap stocks will rally, and just to get into the charts, there are absolutely zero sell signals right now, but there are certainly some developments to watch. And then the other thing to consider too is, the market likes to surprise the masses. So while we don't have any sell signals, and typically next week's usually the markets go into holding period, there are some levels to watch, and sometimes the market likes to surprise the masses. I'm going to talk about that. We're going to look at our Palladium trade today, what happened with Palladium prices, and kind of correlate that to what could happen to the stock market. I know I've been talking the talk of a potential big correction coming up, and I still see it in the charts. Nothing much has changed. Going back here, if you were to go back into videos from months ago, back here in July, I said, any new high would be a divergent high and a marginal new high, and I did back then was saying 2, 3, maybe 5, 6%, and that's about as much as the index has gone. The market has gone up. It's about 6% higher than when it broke out. This was our breakout point back here. Right there, we broke out the new highs. We had pretty much double tops there, divergent highs, little corrections off each one, and so that's that 302 level. And again, we're up about 6% from there, and that's since back in July. So in 6 months, we've gone up 6%, about 1% a month. Today alone, I mentioned yesterday we recently, had a, most recent short trade on coffee for a quick 5%, 5-6% pullback trade. And today was Palladium. We had a comparable trade. I think that was from high to low. I think it might have hit even from the breakout point this morning, which was triggered today, was still about a 5 or 6% drop. I'll get to that in a second. And then where I'm going with the whole let's keep an eye on the charts thing and not become complacent, it makes me think of the Tet offensive. For those of you as older than me, been around longer than me, you probably remember during the Vietnam War, the Tet offensive was considered the turning point of the war. Tet is a Chinese New Year, so I think that was back in end of January. Our calendar is January 31st, I think, somewhere around there, where the Chinese New Year was kicking off. And so the U.S. troops just weren't prepared. They figured the Chinese would be partying. That's their biggest holiday of the year. I'm sorry, the Vietnamese. And they launched a massive attack, which, again, a lot of historians consider that the turning point of the war. So what am I saying? Well, who knows? Right now, I don't expect any big fireworks. But that's the thing about trading is you have to expect the unexpected. And from periods of very low volatility, we'll get to these charts in a second. We're right on the wedges. I'm going to get to those in a second. I'm going to loop back to the, just use that Palladium trade today as an example. Okay, so for example, Palladium has been in one of the most strongest, most resilient uptrends of just about any commodity for a while. It surpassed the price of gold. It's the most precious of precious metals now. Tremendous demand, nothing. And I mean nothing but bullish speak coming out of every analyst you hear. Shortage of palladium, not enough to meet production. But yet, it's been on watch for a correction based on the technicals. And we had recently had the divergent high here, negative divergence, just like we did back then. And then this was from 2 days ago. Posted this chart, 2 days ago. That would have been Wednesday. Stating, here's our sell signal. Break of 1885 would take us down to 1800. And, of course, that's what happened today. And so we had our sell signal triggered. This is Palladium started out here. The total drop on the day was 6%. That drop, I think, was about 4.5, a little shy of 5% once our 1885 target was triggered. Where am I going? What does this have to do with the stock market? Well, when you have such a, extended, persistently bullish trend that starts to pretty much just convince everybody that the correction is just not possible. All dips are being bought. What happens is shorts get blown out. Shorts eventually capitulate. They get squeezed out, whether they want, whether they're getting margin calls or they just can't take the pain anymore. And, so it was a strong chart. Of course, we had, as I mentioned, the reason I was on the lookout for the breakout, we can start to see volatility, just like at the previous top. Prices start to, you start to get that choppy action, and then what you want to look for is a breakdown. So we broke the channel, put in the divergent high, broke it. But here's the point. Again, the biggest drop by far in many months on Palladium. And I imagine, I won't even bother checking if there's a headline. I've traded long enough to know this. This is the nature of this beast. Whether there's some headline out there about, all of a sudden a change in supply-demand dynamics or some news, it was 100%, technically triggered. As I just showed you, with that other chart. We're waiting for a break 1885 for the next sell signal. That came today in waterfall. So point is, when you have lopsided positioning, everybody's bullish, everybody's long, and very few are short. That's where these big drops come from. Why is that? Well, look at it two ways. Everything works on supply and demand. Everything in the financial markets, all stocks, indexes, and I'm speaking metaphorically here, but when the last of the bulls have bought his or her last share, let's say it's Palladium, last contract Palladium futures, or the last share of Apple, the last bull. Again, metaphorically speaking, there's nobody left to buy. On top of that, after these extended runs, bears give up. They capitulate. Shorts cover. And so when a security drops, when you don't have a lot of shorts, when you've blown out all your short interests, there's nobody to cover. Shorts are, and I say this often, they are the only guaranteed buyers of a stock or a security such as Palladium, whatever they're trading. You may be insanely bullish on the stock market or Apple or Palladium or whatever it is in rhetoric, but you don't have to buy. You may plan to buy. You may tell everyone you're going to buy. You can add more shares, add to your position, or take a position, but you don't have to. If you short a stock, The only thing that you must cover, that's a guarantee. At some point, you must close that position out by buying the cover. That's how shorts close their position. They short a security they don't own. They're borrowing somebody else's shares, or in this case, it's a futures contract, and at some point they must close out. So when they're gone, what happens on the big drops, big sell-offs, and this happens in the stock market too after big run-ups, those drops are usually very swift and catch a lot of people by surprise. Think again back last quarter, October, November, December of 2018, same thing happened. So just food for thought. And again, I won't go into too much detail here. I'm not going to go into my Outlook members. I'll post another update on on PA where we go from here. I just wanted to kind of use this because I think it's a good analogy. And the same thing we saw with coffee the other day. I made mention on the YouTube channel that we had a quick pullback trade of 5% in less than 24 hours from where we shorted on coffee futures on a back test of a 60-minute pattern, the bearish technicals. But the bigger picture is that's coming off being bullish, and we just hit the day before that my 60% upside target. And this chart goes back to, here I'll go through them all the way back to May 8th. Posted this chart on May 8th earlier this year, saying these are my targets right here in the potential gain. And this so happened to be the very day of the low. Coffee bottomed on May 8th, not May 9th, not the week of May 8th or 10th. It bottomed this very day. You can see these charts always time-stamped and screenshotted, or time-stamped when they're screenshotted. And the buy signal was to come on a breakout there. So you can see, followed up. That was the next update. We started to move up, put in that low there on May 8th. We're moving up right on the trend line. This was posted on June 6th, after we broke out. Still had us going up here to hit that 60% target. Another follow-up with an additional trend line. Watch for an impulsive break and or weekly close above. I added a second trend line. That'll give you the next buy signal, take us up to that 60% target. Voila, boom, 60% target hit to the penny. Not a 5 cents off, 3%. It was hit to the penny, and then from there we pulled back, and so that was that. The 5% trade was after closing out. We had long trades on coffee throughout the year, and so the point is, you get these overbought, very strong corrections, and the pullback in coffee so far has been pretty strong. Let's just take a look at that chart. The drop off that high when that target was hit so far has been 11%. I'm just measured. This line just measures the drop there from the highs right there. That's when that long-term target that I had of 142 was hit, down to the initial swing target. And that was our last short entry there for the quick 5% drop down to this next target here, this bottom of the ascending broadening wedge pattern. Okay, so back to the stock market. Since this is, we'll leave this one as public. Those trades are, for the time being. There's certainly more potential on both of those. I'll do additional updates on the site for subscribers. But as far as the markets go, here's where we're at. We are sitting precariously on these uptrend lines. Again, zero sell signals, but we do have divergences, overbought conditions, all the other conditions we had, or many of the conditions, I should say, in previous drops. So there it is. And of the three big sectors or indexes, I should say, that I follow, I'm really liking the small caps here. But as I said before, you'll need to see the large caps break. If you break, this is RTY, guys, if I didn't make mention, it's up in the top upper left-hand corner, RTY, the March 20, these are the continuous contracts, futures, and that's it. So you get a breakdown there, and this target being hit, and again, this is just a mild pullback target. This has the potential to trigger some more bearish developments on the longer term daily and even weekly charts, but as of now we don't have that. What would that be? For example, maybe a bearish engulfing candlestick or some other reversal pattern on the daily or even weekly charts. Right now, just looking near short term and looking for just a relatively minor pullback. That would be, let's say we broke down next week, and I measured out for you about a 2% drop right now on the small caps there. And again, we're right on the line, but as I like to say, support is support until unless broken. We were on the line there with divergence. We're on it here, here, here. But this is getting pretty ripe. This looks like a wedge that's ripe and ready to pop any day now. And for that target to be hit, we'll most likely need to see the large caps participate as well. In other words, break down. So I've marked the levels, the salient levels here are marked in yellow right there. I need to tighten that line up a little on NQ. So these are NQ, the Nasdaq 100 E-mini futures. Divergences just continue to be extended here. Let me drag that line if I can grab it. Sometimes it's hard to grab because I have another line right above it. I have that red overbought reading level right there, 86.72. Covered that quite a bit recently. That's normally anything 70 or more on the RSI is considered overbought. This is an RSI 9. And you can see what happens. You hit that level, you usually get at least a little correction there, and then what's happened in the past, you diverge, and you get a series, either one or more lower lows on the RSI right there to give you that negative divergence there after the extreme overbought reading, extreme overbought, and now we're diverging. And so I have the technicals. Look, the trend is resilient, but that's what it is until it isn't. It's kind of like a yogiism. The trend is strong or the trend is bullish until it's not. It's as simple as that. So when is it not? Well, at least for near term. Again, pullback trades like this one right here. That sell signal will come on a break of this, that trend line right there. Initial and minimum target there, and a break of that level, 85.94-ish, give or take, should open the door up for a move down here to about 84.85. What would that constitute if that was hit from where we're at right now, about to close the week out? 80. Let's see. Oh no, there it is. About 2.5%. So let's just see what happens. We'll go from there. Should that play out, it'll probably look something like this. Is what I expect. Break of the trend line gives your sell signal, most likely get a reaction on that level, and then your next sell signal comes if and when that level breaks for a move down there. And again, where we go from there, whether that's a get long for the next leg up or maybe look for more downside, will all depend on how the charts develop, if we even get the sell signals next week. Okay, that's again the contingencies. As with any trade setup, there's certainly a difference, and a very important difference between an actionable trade and a trade setup. I can speak the bearish speak for days, weeks, months, even years on certain sectors or indexes. But when you're in an uptrend, looking for things that typically signal a trend reversal. But again, without the sell signal, you don't have an actionable trade. So right now, that's it. These are still above trend. There's your trend line on ES, the S&P 500 futures. Initial support level there, about 31.90, with a likely target if and when that's taken out, down to about 31.61. And divergence line has to be moved up here. Like I said, these are just divergence lines, and they will be moved up and down depending on the. Well, there it is. I'll just delete it and just add it in there. Sometimes it's hard. This is a little clunky software here. It's not as flexible as the TC2000 program that I'm usually using. They don't have futures. That's why I'm using this one here. Either way, you can see the divergence. You know where I'm going with that. And then finally, the 60-minute charts for you guys that don't trade futures. I like to keep an eye on the futures. It'll give you a heads up. You can pick up additional trend lines and support and resistance levels you might not pick up on the indexes that trade from 9:30 to 4 p.m. Whereas the futures are trading around the clock. But there it is. Nice clean little wedge on SPY. Negative divergence continuing to build. All we need now is a breakdown, and that will trigger a pullback to, should be about the same, roughly. Depends if and when we break down, about as much as 4%. But even these initial targets down here, that's the right now. Like I said, my preferred pullback target, minimum targets down there. It's about a little less than a 2% drop on SPY. QQQ. Here's your divergence line, but as I did in the midday update today for members, we also have this price channel right here. So this line and this line here together, I'll draw them out for you, form a price channel. They're parallel trend lines. And that would be right here. And that's the one you have to watch. The upper line, sometimes you can trade off, if you're trading, you pull, right up to the top of the channel, close along, maybe short it back for a pullback to the bottom of the channel. But the sell signal, the most important development, would come on a break. And again, you want to see QQQ, SPY, and, well, the small caps will most likely follow, but you want to see QQQ and SPY both break down. And the targets are comparable. You usually get a little more bang for your buck if you're trading QQQ. So you can see there where SPY, I'm looking for about a 2% pullback. QQQ, probably about a 3%, because again, it's a higher beta index. The more volatile, chock full of tech stocks, they tend to rise and fall more than the steady Eddie dividend paying stocks within the S&P 500. So, like two preferred proxies, whether I'm trading long or short, if I'm trading the indexes, are usually QQQ or the NQE mini futures, as well as IWM or the RTYE mini futures. And that's it. Today's midday update, guys. I covered some things to watch for in Treasury bonds, other things that are just these end of day videos, the public videos are limited to coverage of the broad market. So there's a lot of other things out there, and again, things like coffee and platinum, just to name a few, that these have both been in the just this week alone, just quick pullback short trades for 5% in a day on both of those, less than 24 hours. Whereas, it's been, I don't know how long since this market's moved up 5%. It's been a while now. It's taken all month, actually. That's it. We'll go back down here. And that's QQQ. The broad market, of course, not as much beta in there or volatility. So it's the market itself since the beginning of the month, or even at the lows. You go to the beginning of the month, it's even less than that. Here's right here. Yeah, right there is December 1st. See, a month to date, you're talking about 3%. And again, you can trade individual commodities, individual stocks, and you can make that in a day. So we'll continue to watch this, but then where I'm going with this, I'm not trying to beat down the market saying they're not tradable investments. Look, it's been a good trend. If you've been long this trend, congratulations. If you've been buying dips, congratulations. And again, that works until it doesn't work. That's what I like to say. But I sit back and wait for the quick trades. And the one reason I love shorting stocks is they tend to fall much faster than they rise, whether it's the indexes or anything else. That's just about the one constant you'll get in trading and investing. All right, we'll wrap it up here, guys. And again, have a great weekend. And I will be around next week. I typically don't trade much, if at all, during the week of Christmas. Things are real slow in the market. Low volatility and low trading volumes tend to lead to increase in false breakouts, whipsaw signals. Hence the reason for trying to stay away unless I see something compelling. But I will be around, and for members of the site, I'll be able to work on catching up to any questions or chart requests over the weekend. This has been Randy Finney, and hope you enjoy it.